Okay, hello everybody again. Thank you all for joining us for tonight's webinar. Tonight's webinar is actually about value versus growth investing. And you guys should see Thomas on the screen, should be above myself. He's actually a writer and founder at steadycompounding.com. So he's been investing for more than 10 years and he'll be sharing his insights today with us. But joining him is also Sebastian. Sebastian is a regular frontman here at Syfe as well. So over to you, Thomas.
Hi everyone, thank you for joining us today, and a special thanks for Syfe for putting this together. So I have more than 10 years of investing experience, and today's topic speaks very close to my investing style because I've been through the various stages of investing, from deep value to growth investing, and and more recently hyper growth. And so today I want to try and answer the questions that many of you have, like why are these unprofitable companies, why are they doing so well, and also like is value investing dead, so on and so forth. So when we look at value investing, right, it could actually be classified into three buckets. And this is well documented in Warren Buffett's growth as an investor, right? So he actually started out as a deep value investor. When I say deep value investing, right, it means investors in this category usually hunt for companies with very horrific outlook, which is why you're able to get a super cheap price today. And most of the time when you're buying these companies, you're actually buying at below liquidation value. What I mean by this is, if I were to acquire the entire company off the public market today, and I start selling all their assets, I'm able to get back the cash, which is going to cover above the cost that I paid for this company. And so these companies are actually worth more dead than alive. And then afterwards, after Warren Buffett left deep value investing, he actually moved on to investing in quality company, also otherwise known as growth at a reasonable price. The short form for this is called GUP. And in this example, I'll go through like why did he make the change and how he has actually performed since then. And then more recently, last year, we see Warren Buffett company, Berkshire Hathaway, actually took an investment in Snowflake, a software company that is actually growing at over 100%, but it is loss-making. So we will also explore the reasons, like has the market gone crazy? Why are they pricing all these loss-making companies so highly? And they have actually performed really, really well in these few years. And so when I look at the business life cycle, right, when we are looking at hyper growth investing, companies that are growing at more than 40%, we are looking at the very, very early stage of the company. They are growing very fast, but the thing is the range of the outcome is also extremely wide. Only a handful will survive and many will not make it. And then when we are looking at quality investing, right, growth at a reasonable price, we are looking at companies with a very established moat. They are already quite mature and they have profits to show. And then for deep value, we are looking at companies that are declining. Their outlook is not exactly great, but because they are trading so cheap that they are below their liquidation value, you can actually own them. And if there's a catalyst that occurs, it may unlock certain values for you as an investor. So let's take a look at all these high-profile investors, right, of various investing style. Benjamin Graham is the father of deep value investing. He's the one who invented it. And then Walter Schloss is his student. Seth Klarman is also known for wanting to buy very, very cheap companies. And he's halfway between growth and deep value. And so when we look at their investment returns over decades, right, they have actually performed really, really well over the market. Ben Graham at 20%, Walter Schloss 15%, and Seth Klarman 17%. And so when we look at growth investing, right, it is important to note that it's not good enough to just look at the absolute returns. You also must look at the duration of the returns. And in this case, Warren Buffett, he has more than 5 decades worth of track record. When you're growing your money at 20% per year, right, it's actually pretty insane. You're doubling your money every 3.5 years. In 7 years, you will quadruple your money, so on and so forth. When investing, right, before I go into like the different style of investing, it is important to think like a business owner. So like if you were to imagine yourself owning a furniture shop like Courts, for example, if you own the business, you would actually have access to the cash, the inventory, which is your furniture, your TV, so on and so forth. Your receivables is how much money you lend to your customers. So for example, Courts usually have an installment plan when you purchase their furniture. So this is called receivables. Then you also own their property and equipment. You also have to take care of the amount of debt owned by your company. And you also have rights to all future earnings of your company. So when we are talking about the deep value investing style, right, we are really looking at the left side of the slide. You are looking at how much assets you own, and then less of how much debt you owe. And then for growth investing, we are really looking at the future earnings of the company. Okay, so deep value investing, how did it come about? Deep value investing actually arose out of the Great Depression, right? Back then, 1929, the market went into a downfall. Unemployment was high, crime rate was also high. People generally didn't wanted to invest. So a lot of these companies, it is not that they are bad. It's just that nobody wanted to invest. So they were so cheap that they were trading below liquidation value. You could literally buy the company out of the market, sell everything, and then you would make a profit. And this was really what gave rise to deep value investing. And Benjamin Graham, he actually started his fund in 1926. He was almost wiped out in 1929 when the stock market went into a free fall. And bear in mind that this fall is not like our most recent COVID-induced market crash, right? Where it only lasts for a few months and it took a V-shaped recovery straight up. This one actually lasts for almost a decade. So it made a lot of people hesitant to invest. And it also made Graham a very defensive investor. It was not enough that these companies were earning money, they were profitable, but he also wanted them to trade below liquidation value. And I'm going to give you a case study today, right? One example which I was looking at back in 2015, Creative Technologies. So back then, for those of you who are old enough to remember, right, Creative actually had the Zen player, which is their version of iPod. And they were an up-and-coming tech darling in Singapore, coming up with super good technology. And in around 2008, they actually sued Apple for copying their technology, right, their UX, their user interface for their product. And they won. They actually got $100 million. And the market was actually pretty excited about what they could achieve, going forward, because they have this great product. But as we know, they did not do very well. And that 100 million that they won in 2008, right? Even until 2015, they did not really put it to good use. You can see on their assets, right? There's almost $100 million worth of cash sitting there. And so when we are looking at deep value point of view, right, we want to look at, if I were to sell off this company today, how much can I get? For cash, right, it is guaranteed in the bank. So this one, you will definitely have it. For other items like how much your customers owe you, or your inventory, which is their audio system, all this, we have to apply a discount, because you may not be able to get back all your money from your customers. They may default. And also your inventory, imagine like if you have to sell your products as soon as possible, usually there's a fire sale for it. People will not want to buy it off full price. So for this, cash, we'll take it at 100%. Receivables will apply a 20% discount, and then the rest of the assets, we will apply a discount 1/3 of its value off. When it comes to its liability, which is how much they owe, and how much they owe their suppliers, how much they owe their bank, we will take this at 100%, because even if you were to sell your company off today, liquidate it, your debt, you still have to pay. So we will take 100% of this. And so when we start to write down the value, right, cash is 100% because it's guaranteed. Then the rest, we apply an appropriate discount. We will come out to an asset value of about 140 million. What they owe is about 57 million. So their liquidation value in this case is about 82.8 million. And when we look at this on a per share basis right here, if we were to liquidate the whole of Creative Technologies back in 2015, we would get about $1.18 per shareholder. And this was the share price back in 2015. So in this example, Creative Technology is worth more dead than alive, right? Because the market feels that they will destroy value over time. And so they really assign a very, very low valuation for Creative Technologies. And they are priced 22% below their liquidation value. So let's take a look at, how they performed since then. In around 2018 or 2019, the share price actually jumped more than 600%, right? Because there was a technology that came out, and the market, they thought that this would actually help Creative Technology turn around. But here's the thing about deep value investing. Unless you're able to acquire a large enough stake to influence management, you start making some changes within the company, most of the time you will not have control over whether there's a catalyst that will happen. So for most deep value investors, the well-known ones like Peter Candil or Benjamin Graham, they generally own a lot of these investments at one time, 40, 60, or even more, because you don't know which one will turn around, right? And by owning a lot, the number of winners will outweigh those who don't turn around at all. And here's the thing about creative, right? When it shot up about 600%, I sold as well. I didn't buy into the story, largely because the directors was selling like crazy back then. The market believed in the story, but their directors did not. And so as investors, it often helped to actually look at what the insiders are doing. Whenever they do anything, they have to report to the exchange. Okay, so here's the interesting thing about deep value investing, right? For Benjamin Graham, who is the father of deep value investing, he owned one growth stock. And the amazing thing about this one growth stock, which is Geico, right? Which is an auto insurance company, it actually, the amount of money he made from this one investment actually outweigh all his 20 years worth of deep value investing. That was how much money he made from this single investment. But the regrettable part is he was a bit old by the time he noticed growth investing, because he was a product of his environment, right? Out of the Great Depression. So his thinking is always, I must be super conservative. And luckily for Warren Buffett, he was extremely young back then, and there was another company that did it for him, that helped him pivoted to become a growth investor. And it's this company called Seif Candy. They started in 1918 by Mary Seif. And this company they produce the kind of chocolate that you want to bring to your date on Valentine's, right? A really high quality chocolate. And they have a really good brand. Throughout Great Depression, when all businesses are cutting costs, they are not profitable. Mary Seif, she still insisted on making sure that the ingredient for her chocolates are always the best, which is why they have a very good reputation along West Coast. And of course, all businesses, right? All family-run businesses, you have to hand over to your children. And this is where the opportunity came for Buffett and Munger, right? Warren Buffett and Charlie Munger. Because when they hand over to their son in the 1970s, their son was not interested to run this business. He was more interested in partying and going to the beach. And so there was a short window of opportunity because he was half-hearted. Should he run the business, or should he actually sell and then go and enjoy his life? And in this case, right, Warren Buffett, he didn't wanted to pay for more than 25 million, but the son of Seif's family, he actually wanted 30 million. Charlie Munger was actually the one who convinced Warren Buffett to pay up and for the son to actually take the money to go and enjoy his life. And so when we look at his investments back then, Seif in 1972 was generating $30 million in sales, 4.2 million in profit on just $8 million in assets. Just imagine what a great business this is, right? You invest 8 million worth in assets, is able to generate 4.2 million in profit. That's a return on invested capital of more than 50%. It may seem like super cheap now because Buffett only paid 6 times earning and 3 times book value. But bear in mind, during this period, before the investment of Seif Candy, Warren Buffett was actually a deep value investor. So he's not used to paying more than 1 time book value. And it was really this good experience of owning a high quality company, right? Whereby you don't need to go in and influence the management, fire people, so on and so forth. And yet it compounds your money at a much faster pace that led him to discover Coca-Cola. Back then, he was paying close to 20 times PE and the market was calling him crazy. In today's time, we may think that 20 times PE is okay, it's fine. But during his time, the market was finding it to be overvalued. But, the investment actually turned out extremely well for him. And so, like, if there's one thing you remember today, right, you have to remember this quote by Charlie Munger. Over the long run, it is very hard for your investment to earn more than what the underlying business is earning. So if a business is earning 6% return on capital, right, over multiple decades, even if you buy at a super cheap price and it revalue upwards, you're not going to make a lot more than 6%. Vice versa, if you own a company, a good quality company that's generating 80% return on capital, even if you were to overpay the valuation and subsequently the valuation string, you're still going to make a lot of money. Not that easy to understand when you first see it, but I'm going to walk you through an example. So for this, let's take a look at company A and company B. when you look at these two companies' share price, at today's point, they are both earning, I mean, the share price of these two companies is $40 each. But one of them, company A, is earning only $1, right? And the other company B is making $4. At the first glance, you're going to think that company A is 4 times more expensive than company B because you're paying 40 times earnings for company A while you're only paying 10 times earning for company B, right? But here's the thing. Company A is able to grow its earnings at 18% for 2 decades, while company B is only able to grow at 6%. Despite starting from a way smaller earnings, right, company A will be able to double its earnings, double company's B earnings 20 years down the road. And we further handicap company A valuation, which means company A valuation were to shrink by half, while company B valuation were to double. And in this case, the share price for company A will actually come out to $547 and company B only $256. So even though company A valuation actually shrunk by half while company B valuation doubled, the investment results that you will get from company A and company B is still vastly different, right? When you are owning a high growing company, a good company, good quality company that's able to grow for decades, right? Even if you were to pay an expensive looking PE multiple of 40x and subsequently it shrink to 20x, you're still going to get a better result than owning a company that's a slower grower. And so the number one rule of investing is to fish where the fishes are. So when we look at these studies across 2 time periods, right, we have an insight that good companies tend to stay good. Like when we look at the left side of the chart, you know, these companies generate way higher return on invested capital, right? And if you decide to play the long-term game, you know, you want to stay invested for the long term, you generally want to invest in, you know, the right industries and the good companies, because the winners just tend to stay winners over time. And holding poor companies, and in this case, by poor, I mean low return on invested capital, over a long period, it will not make very good investment. And, you know, when COVID happened and SQ price actually shot down, a lot of people would ask me, is SQ worth buying? Then you have to understand what's your game as an investor. If you're a long-term investor, the airlines industry is a notoriously low return on invested capital industry. It is usually below 5%. So if you decide to hold the company for a long run, you will not do very well as an investor. So now I'm going to go through with you why Warren Buffett actually bought Apple in 2016, right? He is always someone who always say he will not invest in tech company because tech company is very vulnerable to changes. Things change very fast. But in this case, he sees Apple more as a consumer brand. And so let's take a look at Apple's valuation. When it comes to mature company, the quick and easy way to value them is actually just to plot their PE ratio over a decade. And then we look at what's the average, you know, and for Apple PE ratio, right, the average is usually around 20 times. And there was 2 occasions whereby Apple traded below 10 times PE, which is in 2013 and 2016, point A and B. And, you know, the narrative back then was really bad, right? They were saying like Apple would become like BlackBerry or Nokia, you know, it would just die off. And when we are looking at Apple as an investment, the facts that was presented is that Apple is still growing. Whenever they launch a new iPhone, people is still queuing outside Apple store. Long lines is still forming, you know, and the return on investor of Apple is also very high. Back then, the S&P 500 had a PE multiple of 23 times. This means that the average company in USA is worth about 23 times multiple. And when we look at the Straits Time Index, right, the average Singapore company is worth about 15 times PE ratio. And when we dig further into Apple, you will realize that there's about $200 billion worth of cash sitting on their balance sheet. It was just because this is such a good business, right? That is gushing cash all the time. Their balance sheet was really gathering a lot of cash. If we were to back out the cash from its valuation, right, its PE multiple is actually just 7 times. And Warren Buffett is often, he often say, right, when he does valuation, there's no need to take out a calculator. There's no need to take out an Excel spreadsheet. If you need to do that, it's probably not that good an investment. And in this case, we need to ask ourselves as investors, is Apple at 7 times PE lousier, 3 times lousier than the average company in America, or like only half as good as an average company in Singapore. If you disagree with the narrative that Apple is going to become like Nokia or BlackBerry, then it's probably a good opportunity for you to enter a position back then, and which is exactly what Buffett did, right, in May 2016. And since then, he actually made about 500% on his investment. Okay, so when we are investing for quality, we are investing for growth, it is more important to get the quality right. By quality, I mean like how long can this business last, right? What's their competitive advantage that will prevent competitors from coming in? When you look at the best breed of companies, right, like for example, L'Oreal, PepsiCo, or even Colgate, you could have paid really ridiculous PE ratios of over 100 times, or even for L'Oreal case, close to 300 times, and you would have still made money, right? This does not mean that you should go and overpay, but the key takeaway here is that you always have to get the quality of the company right when you're a long-term investor and you're investing for growth. Okay, so now moving on to one of the topic whereby I get a lot of questions, hyper growth, right? Companies that are not profitable and growing at more than 40% a year. Why are they doing so well in the stock market? So when we take a look at the latest group of company, right? In the past, for a company to reach $1 billion market cap, it takes about 20 years. But in recent years, it's taking less than a year for them to reach this market cap. And it's really largely due to how fast this company are able to grow because of technology. So let's take Starbucks, for example. If you want to grow a cafe, you need capital to set up multiple restaurants all over the place, right? And then you need time to hire people and all that. But when you look at the digital businesses today, when you are scaling, there's no such restriction. If Netflix want to onboard an extra user, it doesn't take more than a few seconds for them to do so. And they can scale, multiple people can be onboarded at one time. There's no customer service. There's no like salesperson there pitching you, like telling you have to sign up and all that. Everything is automated, which is why they are able to scale extremely fast and grow their revenue at a much faster pace than the more traditional companies. And so here's the interesting thing, right? There's a shortening adoption cycle for many of today's products. Right, when we take a look at how long it takes for airlines to reach 50 million, or even our television, or even just our credit card, just a piece of plastic card, it took decades. But when you look at stuff like YouTube, it takes 4 years, and like just make a guess. For Facebook, it's just going to take 3 years. Twitter, 2 years. Now, I have a short survey for all of you. I want you all to make a guess. How long do you all think the Pokemon Go take to reach 50 million users? Like, if you can remember, like what a crazy rage it was, right? Pokemon Go, everybody was playing it. Like, how long did it take for Pokemon Go to hit that 50 million mark? Three days, 19 days, 5 months, 1 year. Yeah, you guys, most of you are right. Pokemon only took 19 days to reach that 50 million mark, right? I don't have the figures for TikTok here, but I would think that TikTok probably took under a year in this case as well. And so, for companies to scale nowadays, it's really way easier because products just spread so fast. And the narrative for a lot of these businesses, right, is that it is priced to perfection. When Amazon first came out, they call Amazon bomb. Facebook is not worth that much. It's only worth $15. The truth is, for these businesses, because they are able to scale at an extent that we have never seen before, right? It is very difficult for analysts to measure their potential, or in this case, we call it the total addressable market, short form for TAM, right? Almost every product that is 10 times better than the legacy product, they underestimated their TAM. For example, Airbnb, or in this case, Uber, right? In 2008, Uber estimated that their best case scenario was that they're able to generate $1 billion in sales only on 4 billion worth of total addressable market. And in this case, they thought that the maximum total addressable market that they're replacing is only taxis. And that was how Uber and Grab started, right? Grab initially called themselves Grab Taxi. because they only expected themselves to replace the taxi market. But little did they know that when you are able to develop a product that is 10 times better than the yellow taxi, people in New York is always complaining the yellow taxi, they are rude, it's expensive. And the experience just wasn't that pleasant because it's hard to get one when you need one. And Uber came in to provide a solution that was 10 times better than the previous experience. And so in 2019, I took this figure because it's pre-COVID. They actually made $13 billion in sales. 13 times what they thought they could have achieved. And valuation went from 5.4 million to 85.6 billion, a 15,000x return. And a lot of times you may be wondering, why are they unprofitable, or rather why these unprofitable companies are doing so well, at least in the stock market. And we have to notice that in the 1990s, the amount of intangibles actually exceeded the amount of tangible spending. What I mean by intangibles in this case is, like you spend marketing on things that you cannot touch, right? Marketing, research and development, marketing to build up your brand, research and development to make sure that your Amazon.com checkout experience is the best for your customers, or you try and string your delivery time. Long time ago, when you order something from the internet, it's going to take like 3 weeks to 1 month to reach you. Amazon managed to do it in 2 days, right? And a lot of investment have to go into this, and all these are intangibles. And then, tangibles are things like our property, our equipment, your Starbucks barista machine, for example. And so as the economy, as the world starts to digitize, right, there is more intangible investment than tangibles. And there's a problem for this, right? Those companies that are heavily investing in intangibles will appear unprofitable. And here is why. It's largely because accounting has not caught up with the current trend of companies spending on digitalization, right? So I'm going to give you an example here. If we were to invest in a tangible, an equipment or property, right? And I spent about $100,000 this year. Accounting requires me not to recognize $100,000 as an expense this year, but rather I will recognize the expense over its useful life. So let's say I'm investing in a coffee machine this year, I will recognize it over 5 years, its useful lifespan, right? And so every single year, I will only recognize $20,000 as expense. Whereas if you were to invest in your branding or invest in your e-commerce website, such as Amazon, right? When we are investing in intangibles, accounting actually requires us to recognize 100% of the expense upfront. So even though when we are investing in tangibles, its purpose is to generate income for us, and intangibles is also to generate income for us, even if they are generating the same amount of income, one of them will look unprofitable and one of them will look profitable. So in this case, like just take, for example, both of them are generating $40,000 in the first year, right? The tangibles, if they spend $100,000 and they recognize it over 5 years, we will only recognize $20,000 worth in expense. So they will show up as $20,000 in profits, whereas the intangibles will show up negative $80,000. So when it comes to this, right, Jeff Bezos is really the one who is able to put it in writing super well because he wants to attract the right shareholders. For him to continuously invest and ignore the short-term Wall Street, right, he has to attract the right group of shareholders. And let's take a look at his first letter as CEO of Amazon, right? And he says that he will make decisions in terms of long-term market leadership considerations rather than short-term profitability consideration or short-term Wall Street reactions. When forced to choose between optimizing the appearance of our GAAP accounting and maximizing the present value of all future cash flow, we will take the cash flow. And this is really at the heart of investing, right? All investments, all intrinsic value is actually a discounted value of all your future cash flow. And so Jeff Bezos knows this, and he communicated out in his first letter. And every single letter he wrote in the subsequent years, he will attach this letter to his shareholders because he wants to make it very clear. We don't look profitable, but that is intentional. We can actually be profitable whenever we want to, but we are actually investing for the future to make Amazon a much bigger and stronger company. And so when you look at this, this is his vision, because when you become a market leader for a platform company, for an e-commerce company like Amazon or Shopee, for example, right? Market leadership will directly translate into a stronger position. You will be way profitable when you're a market leader. And this is the thing. Whenever we read news, they are just going to say back then Amazon is super unprofitable. But when we dig deeper into how much they are investing for future, right? And we add back these capital expenditures, which they are investing for growth, they are actually super profitable. You can see that there's a difference of 10.4% if we are able to add back these expenses, right? The line in blue is actually the expenses based on GAAP accounting. Based on accounting, we take it at face value. But if we were to start digging deeper and we add back all these expenses that he's actually spending to grow the company, they are actually hyper profitable. And the gap only widen over time, right? They start to get more profitable over time because of operating leverage. And so a lot of times people struggle to pay up for these growth companies, right? Valuation is important, but what is more important is how long these companies can compound. How durable is their growth? And so when we look at, the quadrant from 15% to 35%, if they are able to grow for the next 10 years at this rate, it's very difficult for you to lose money on valuation wise. Do bear in mind, do be cautious that not every company can grow like an Amazon or Salesforce. Amazon grew for almost 30% for more than 2 decades. That's just an insane amount of growth, right? So the point here is that durability of growth is more important than anything else. And when we look at this chart, which I got from Peter Thiel, right, one of the smartest VC investor around, when it comes to investing for growth, and this chart is actually a chart of discounted cash flow. You don't have to understand what discounted cash flow is, but it's important to know it where the valuation is coming from. So most of the valuation of a company, right, is going to come from year 5 onwards. That would account for 75 to 90% of the valuation today. Whereas for the first 5 years, right, it would only account for 10 to 25%. And this model is extremely helpful because the key question we have to ask here is, why does this company deserve to be around 10 years from today? This is really at the heart of hyper growth investing. What is it that you see in this company that they are able to achieve dominance, or they are able to deter competitors away 10 years from today? Why do they deserve to be around? And so when we look at, when we try to hunt for the next winner, right, the next Amazon, the truth is the next Jeff Bezos isn't going to be building Amazon. But based on Peter Thiel, there are some common characteristics we can try to look out for, right? The first is proprietary technology. Are they able to deliver a solution that's 10 times better than the previous competitor? But if we only based on proprietary technology, right, it is a bit tricky because another company that can come along in 2 years with a better technology, right, then he's just going to steal all your market share. So we want to make sure that the companies we are investing in, they have a technology that's extremely hard to compete, to copy, or they are always innovating, coming up with new innovations to make their company better. The second one is my favorite competitive advantage, network effects, because it is one of the strongest moat a company can have. When we take a look at Facebook, for example, a lot of us are today on Facebook, WhatsApp, Instagram, because our friends are on there, and the more people join these social media apps, the stronger it becomes, right? You're not going to join a social media whereby there's nobody. Same thing for Airbnb. When there's a lot of people looking for apartments, there will be a lot of hosts that comes onto the platform. And when more hosts come to the platform, people are more likely to visit Airbnb to look for an apartment. And there's this very nice flywheel that kicks in. Economies of scale, it's also very hard to bridge a company once it hits economies of scale. And in this case, like take Amazon, for example, they invested super heavily on their logistics capabilities, such that no company is able to match them in terms of how fast things are being delivered, right? And when the fixed cost doesn't grow with your revenue, then then there's a very nice operating leverage that kicks in. You're able to keep prices low for your consumers. Same thing for Netflix. Whenever there's a new user being onboarded, there's no incremental cost to Netflix. because the cost of the TV production, the show's production costs are fixed in this case. It doesn't grow with the number of users, and so they're able to spread this amount of production costs over a very large user base. And then, branding. Branding is something that's extremely hard to quantify, but if a company is able to get it right, it would result in very efficient marketing spend. When we take a look at companies like Apple, Zoom, or Tesla, they don't spend a lot on marketing, but everybody knows them. So there's this interesting thing I took a look at. For example, Peloton, the bike company, right? They actually spend 23% of their revenue on marketing. Apple only spends 6%. And then we have Elon Musk, who spends 0 on marketing, right? There's only 2 companies that I know who does very well. Everybody know them, who don't spend on marketing. One of them is Tesla. The other one is the luxury bag, Hermes, right? Hermes, they don't hire celebrities, they don't do runway shows, etc. Louis Vuitton does, but Hermes doesn't. So there's only these 2 companies that I know that don't have to spend on marketing. And when you are always at the top of consumer mind, right? It is really just an competitive advantage, because you don't have to spend so much on marketing, and all this money could be distributed to shareholders at the end. And Elon Musk is really quite an eccentric one. Everything we learn from marketing in schools can be thrown out. He just does it entirely differently. So is there a price too high? Yes, right. So when we look at Microsoft, if you were to buy it at the height of the dot-com bubble, the share price is going to go sideways for a decade. And it is extremely painful to hold. Like back in 2000, it's probably quite visible that Microsoft is going to be one of the most dominant player, right? With their operating system, everybody is on them. Everybody needs to use them. And throughout this decade, whereby the share price flatline, the most painful thing is that their earnings are growing, free cash flow is growing, right? Their sales, users, everything is growing nicely, but the share price isn't moving, simply because the market actually paid too much back in 2000. But the truth is, if you were to hold it up to today, right? Today, I think Microsoft share price is about $340. You would have still made about 11 to 12%, right? Just because it is a fantastic company. It is difficult to lose money on a fantastic company, but bear in mind that there's always an opportunity cost when you invest in a company that's too overvalued in this case, right? And it is not easy for investor, to see the share price sideline for a decade. It just go up, go down, go up, go down. It's a mental torture, and not many people will have the willpower to hold through things like this. So valuation is still important. But what is more important, the first question should always be, is this company high quality, and do they deserve to exist 10 years from today? Yep. And with that, I end my presentation. If you'd like to connect with me, you can connect with me on most socials. If you have any questions, I'll be happy to answer them.
Great. Thank you so much, Thomas. So the crowd actually have 4 questions for you.
Right.
The first one relates back to the terms that you have actually used. So they found it kind of too technical, a bit confusing for beginners. So I think you can start off with maybe explaining what's hypergrowth in maybe just 1 or 2 sentences.
Yeah, basically hypergrowth companies are companies that are able to grow their revenue at least 40%. They are just growing at a super fast clip. Generally, most companies, okay, when we talk about big companies like Facebook, Amazon, they are usually growing at around 30%. Hypergrowth companies are companies like CrowdStrike, for example. The most recent quarter growth, they're growing 70%. Or, C Limited, our Shopee, right? They're growing at over 100%. So these companies, we will commonly refer to them as the hypergrowth bucket.
I see. And what about deep value investing? Does it really just mean buying a company before it actually dies so that you can get your liquidation money?
Yeah, so the liquidation framework, right? So when we talk about deep value investing, usually they have very nasty outlook. It is not buying them before they are dying, right? The truth is, after you buy into them, they are not going to die, but the narrative for them is so ugly that the market is not willing to pay up for them, which is why when we look at the case for creative technology, right, the company is actually pricing them below what it would have been liquidated for. Yeah, so it doesn't mean they are going to be liquidated, but deep value, we just want to protect ourselves. And they often ask the question, what if this company fail? what if this company needs to be liquidated? Is my capital protected, right? And a lot of times, whether the catalyst happens or not, and for example, in creative technologies, right, the catalyst that happened was that they came up with an award-winning audio system, and that was a catalyst for creative. But for a lot of these companies, they may not have a catalyst happening, which is why you have to spread your investment over a huge base. Yeah.
I see. So I think this leads into the next question. So do you think deep value investing is actually more risky per se?
I don't think it is more risky. There is many ways to make money, but personally, I don't really do deep value investing anymore because there's always a lot of opportunity cost that comes from owning high quality company. Generally, when you own high quality companies, right, you're able to understand these companies better, and it's just a more pleasant experience to own them. Deep value investments usually appear, good deep value investments usually only appear when the market is crashing, right? Like last year during COVID-19 and during when the March period came. Or, okay, one good example I can think of that I use quite often is for our local banks. So please note that this is not investment advice. Yeah, so for our local banks, right, usually when things happen, like for example, 2018, there was the oil price was falling, right? And a lot of these shipping companies were going bankrupt. And our local banks, the share price took a hit. It had a very big discount, and a lot of them were trading at price to book value of below 1 time. And as investors, you can go in and study what is the loan composition of these oil companies in these banks, right? So for example, DBS, about less than 5% of their loan book is this oil-related companies, but the market actually discounted them to 80% of their book value. So, the market actually swing to the other extreme. And in this case, DBS actually became a deep value investment for me during that period. But bear in mind that for deep value investment, I generally don't hold them for a very long period. Once they realize their value, I will usually sell and move on.
I see. Okay. So maybe one last question. I think this question is really good, right? Do you think we are in a bubble right now, like a dot-com bubble? So
yes. Yeah, I'm sure you guys get this question very often also, right? So when we are looking at and the most often cited thing is, the P ratio of the market is so high right now. Schiller PE is so high. But as we can see from the example between when I was showing you about the Charlie Munger quote, right? And I show you the example on between company A and company B. A PE multiple of 40 times versus a PE multiple of 20 times or even 10 times doesn't mean anything. We have to look at multiple factors, like what is the profile of the companies that consist of the index today, right? And the truth is more than 50% of the S&P 500 index today is made up of companies like Facebook, Amazon, and Google. Companies that are able to generate a very high return on invested capital, much more than our traditional companies, much more than the S&P 500 index constituents have ever generated. And and they are able to grow for a really, really, really long period, which has never been seen before. So when you ask me like whether the market is super overvalued now, I mean, certain pockets, yes, like your software companies, or your mid cap and maybe your small cap. But I do not think that the big caps today are super overvalued. I think they are actually all right. So when you listen to a lot of my friends, like in 2018, they say Schiller PE, P of market is high, due for correction. They are missing out on a lot of gains, right? Because it's very surface. When we just look at the PE ratio, we have to understand what the market participants are made up of today. And it is really much more high caliber companies that's inside the S&P 500.
I see. Okay. So maybe one last question. What is your opinion on like stocks like Adobe and Salesforce, since you were talking about certain companies just now, right? Do you find them overvalued? Is it too late to buy those?
I don't think it's too late to buy them, but at today's prices, it is more towards the pricey end, right? I wouldn't consider buying them at today's prices. And there's a good reason why they are priced at 50 times PE. It is a bit technical, but try and maybe digest this after the talk. It is largely because these software companies, they are spitting out a lot of free cash flow, right? When you look at the typical business like COTS, for example, a customer will buy from you, they may take up your installment plan, cash doesn't come in at fast. When we look at companies like Adobe, right, all the designers, they will pay upfront. Even before they start using the product, they will pay for the services upfront. And, these are cash that can be used for reinvesting or distributed to the shareholders, right? And when we look at the margins of this software company, they are extremely high. Adobe is around 85%, for example. You can't get this for other companies. And the beauty of these software companies is that they're highly recurring in nature, which is why they are commanding a much higher valuation. But a quick and easy way for Adobe, because it is quite a mature company already, is you can plot out the PE ratio or the operating cash flow, price to operating cash flow ratio in a chart over the 10 years. Find out what the average is, and then you try and buy maybe one standard deviation or two standard deviation below the average.
Great. So thank you so much, Thomas. So I think it's all the time that we have for now. We will move on to Sebastian. So over to you.
Great, Thomas. Thank you very much for this very interesting presentation. Highly appreciated. I think a lot of good things in there. I guess this is like really the investing, where you do a lot of research, you spend a lot of time trying to identify which are the stocks, which are gonna win. I guess not everyone is interested to put in this amount of time and effort, right, to go this deep. I guess what Syfe is offering is something which I don't think it contradicts at all, but I think it's a slightly different approach, right, which can be very nicely combined, right, to have a base of something which is a bit more passive, and then you add on your stock picks, which you have. So I will quickly introduce Syfe in this last about 10 minutes. Melvin will try to answer any remaining questions, maybe over the, in writing, or maybe Thomas can help as well, while I go through a couple more slides. Thomas, if you don't mind, and you stop sharing your screen, then I can bring up a few slides about Syfe.
Sure.
I hope everyone can see my screen. And yeah, so I think very quickly about who is Syfe. So Syfe is a Singapore-based digital wealth manager with a license for retail fund management by the Monetary Authority of Singapore. This comes with very stringent requirements to protect investor assets. In addition, we are also holding a financial advisor exempt license, and we are always segregating client funds from company funds, so from the funds of Syfe itself. So client funds are held by DBS until they're getting invested through our broker Saxo and then held in sub-custody with Citibank and HSBC. A very quick look at Syfe's journey. Syfe launched in July 2019. In this less than 2.5 years, we have gotten customers across 42 different countries. Of course, the majority being in Singapore, but even outside Singapore, in 41 other countries. Clients range from 18 to 93 years old. So yes, it's something which young people enjoy, but as much it's a good option probably for slightly older people. And nearly half of our customers are actually referrals of existing clients. This makes us one of the leading personal finance apps in Singapore. Here in the middle, you can see the Apple App Store, where Syfe is the 6th most downloaded finance app after most of the well-known Singapore banks. We also have won several awards. We have won the Best Digital Advisory Solution by DigWin, but we have also just been awarded a week or two ago by the Singapore FinTech Association as part of the Singapore FinTech Festival, which we are very proud of. We have a 4.6-star review on Singapore's largest perennial finance community, and we are growing really, really fast, as well as we have we are very well capitalized. We have raised more than 52 million in capital, which ensures that we can run this business for a very long time. So what do we offer? We offer a suite of portfolios. There are 4 different portfolio types, and I want to just introduce each of them just with like 1 or 2 sentences. And I will go from the left to right. Cash Plus is what we call a so-called cash management solution, which is something where people can park idle cash, which sits in their bank account, earning close to 0 interest in current low interest rate environment. We have a projected return of 1.5% per annum, and there are no lockups, no limits, and no tiers. So this is something which is very safe. So this is in terms of like, it's our most safe investment portfolio, really to park cash for a couple of months while you don't need it. If you're looking for a little bit more return, then we have REIT Plus. REIT Plus is our real estate investment trust portfolio, which gives passive income as well as capital appreciation. So this invests in 20 of the largest and most liquid REITs traded on the Singapore Stock Exchange. The great thing about it is it's a really high dividend yield of 5.1% estimated for 2021. Last year, due to COVID, it was slightly lower at 4.5%. But I think in this low interest rate environment, this is still a really great dividend. And this is something, this is a portfolio where we track the IHS REIT Leaders Index by SGX. So we are following the index, which gives us, these 20 largest and most liquid REITs. Then we have our core portfolio, and this is what we believe should also be the core of your investment. You can choose between 4 different options: low risk defensive or lower risk defensive, all the way to equity 100, which is 100% equities portfolio, which is the one which gives you the highest risk adjusted returns, but of course also comes with a higher volatility. So what is special about these core portfolios? These are highly diversified portfolios. So this basically ensures that you are invested in the US, in Europe, in Asia. You invest across different industries, from technology companies, telecommunication companies, to healthcare companies, and many other sectors. Defensive balance and growth all are also diversified across multiple asset classes. So there is equities, but there's also bonds and gold in there, which gives stability to the portfolio in times of higher volatility or higher uncertainty. And we're using a smart beta strategy to really optimize for the risk-adjusted return and skew the portfolio towards certain sectors which are promising a higher return in the future. If you want to have a bit more control over what is in your portfolio, then Syfe Select is probably a good choice for you. It's a 100% customizable portfolio. You can choose from more than 100 best-in-class ETFs, which has been curated by Syfe's investment team, and build your portfolio completely from scratch. So you choose what do you want to have in your portfolio. Do you really want to have only the big tech companies? Do you want to have dividend heroes in your portfolio? Are you looking for bonds? Are you looking for commodities? It's really up to you to decide. If you want to have a good starting point, you can look at the Syfe Select themes, which are 5 ready-made portfolios covering 13 mega trends, such as ESG and clean energy, other like income focused. There's an income focused option and a couple more. Yeah, and then I just mentioned already that we believe that Syfe Core should be the core of your portfolio. We believe in a core satellite investing strategy, which is basically that you have a highly diversified portfolio, which is a significant share of your overall wealth, because this is the most plannable, the most predictable kind of part, right? Because you're investing in a lot of different companies, which ensures that if there's one company which is maybe a foul apple, it doesn't really like affect your portfolio much, and you benefit from the overall market growth. This you then can combine with different satellites, and the satellites can be your custom portfolio where you really pick yourself, or like Thomas does, like you pick specific stocks, right? Or you can choose one of the themes which I just mentioned earlier: ESG and clean energy, disruptive tech, healthcare innovation, global income, or China growth. Or one of our all-time favorites, the Syfe REIT Plus portfolio, giving you exposure to Syfe, to Singapore's largest REITs all-in-one portfolio. How does it work? Syfe is available across all platforms. You can use you can just go to syfe.com, or you download the app from the App Store or from Google Play. All you need to do is you answer a few questions to get started, and then you will have access to a forecasting tool where you can see what are the different scenarios, how your portfolio will perform. You can play around with different lump sum, different monthly contributions, different durations, and see what are the potential outcomes. And all of this before you decide if you want to invest or not. Once you have made the decision to invest, you will be able to monitor the portfolio on a daily basis and see how it performs. There is one low fee which basically covers all the trading costs which you have usually when you go on a brokerage platform, which is what we call the management fee. For the blue tier, it's 0.65% per annum. That means if you invest, for example, $10,000, then it's just a bit over $5 a month. If you invest a little bit more, for example, above $100,000, this management fees will go down to 0.4% per annum. And in addition, you will have access to the Syfe Wealth Expert team, who will, Melvin is part of the team, who will be able to help you, like if you're unsure which portfolio is the right one for you, etc., and they can explain all of the portfolios in much more detail, and also consider your specific personal information more than we can do in these webinars. One important thing, sorry for jumping around between the slides a little bit, there's no trading fees. There is no entry or exit charges. There's no minimum balance, so you can start with as little as $100, for example, and there's unlimited free withdrawal. So there's, as I like already mentioned earlier, I think there's no lockups, right? So if you wanna withdraw your money after 1 month, you can. There's no fee or any penalties related to this. And of course, we pick ETFs which are very low in cost in order to maximize gains. Yeah, if you think this is interesting, we are offering a 6 months fee waiver only for participants of these webinars. Our regular fee waiver is 3 months. If you sign up, use the code Syfe webinar in order to enjoy up to $50,000 invested for free. Yeah, I think that was the presentation. I'm aware it's already quite late, but I think let us take the time to answer at least 3-4 questions which I saw coming in.
Right. So thank you so much, Sebastian. Maybe like first question is that for those people who have already been investing into S-REITs themselves, right? Does it still make sense for them to use our portfolio like the REIT one?
Yeah. Yeah, I think that's a great question. I think you know, for me, the best example is actually COVID, right? If you you know, which really shows the value of being diversified, right? If you were invested in hospitality REITs before COVID, right? No one could have predicted an event where suddenly for many months, or actually by now, like more like actually almost a year and a half or close to 2 years, hotels really are facing very challenging times, right? If you invest in REIT Plus, you are diversified across 20 different REITs, 20 different sectors. So there are in there logistics REITs, which really benefited from the COVID situation. There are healthcare REITs in there, which also benefited from the situation, right? So you really have a broadly diversified portfolio, which we at Syfe believe is really something, it's really great, especially for someone who doesn't want to do the effort of analyzing every stock like Thomas does.
So, for example, clients who use more than one portfolio, right? For example, $10,000 in the REITs one, $10,000 in the equity 100 portfolio. With $20,000 invested, do they actually get like a lowered fee in the black tier?
Yes, exactly. So the amount is calculated as the sum of all the different portfolios, excluding Cash Plus, because Cash Plus, I think, is an important part I forgot to mention earlier. We are not charging any management fee. So we are charging only management fee on the other portfolios. And yes, if you put $10,000 in 2 different portfolios, you will qualify as a so-called black tier client, and you will enjoy 0.5% per annum reduced fee, which comes down to like, I think, $8 or something per month.
And I think for new investors, they were a bit confused by like the trust or custodian accounts. Maybe you can elaborate a little bit more on that.
Yeah. So I think what this basically means is that, Syfe's own money and our clients' money is never mixed up, right? So even in a worst case scenario, basically those custodians would basically then, is a bit simplified how I explain this, but would basically then return or the client's assets on behalf of Syfe back to our clients, right?
Maybe one more. What's your personal opinion of the pros and cons of using more than one robo-advisor simultaneously?
I think, yeah, so I think there's, like, of course, like, I think we believe that the products we have are really like, are great, right? We are using ETFs, which we believe is the superior security in order to get diversity as well as lowest cost, right? I think we are going for a very passive approach, which in my opinion is also the right kind of strategy for most what's called retail clients, or for most individuals. So, and we have a very complete product lineup, right? From anything, if you want to just park some cash, or if you want to have a diversified portfolio, or if you want to have something really customized. I think all of this you can basically find on our platform. And if you put all money into one platform, then you enjoy these lower fees, which we just talked about earlier. But yes, if you see value in having or being on multiple platforms, then we are not stopping you either. As you know, like there's no minimum investment on our platform.
Great. So perhaps Thomas have some ending statement. I think this is roughly all the time that we have left for tonight.
Yeah, so I'm predominantly an active investor, right? And I love picking stock, but when most of my friends ask me like how should they invest, I actually ask them to go and use Robo advisors, right? And in this case, Syfe actually offers a very, very competitive rate. I think they're one of the lowest, if not the lowest rate up to a certain threshold. My opinion for young investors, right, is to go in, again, this is not investment advice. You have to determine like what is your risk appetite and whether you're able to sleep well at night, right? But for young investors who have a really long runway, right, for me at least, I would go 100% equity, just because when we look at how the market has performed in terms of equity over a super long horizon, multiple decades, they generally perform between 8 to 12%. Even if you were to invest in the most horrible of time, like right before the Great Depression, you invest and then you just held all the way through, you're still going to generate a very, very decent 8% with dividends reinvested. So if you have a very long runway and you don't need the money in the short run, do consider using, I believe it's called Syfe Equity 100, right? Yeah.
Correct. Yes. Equity 100. This is like our 100% equities portfolio.
Yeah. So if you don't need the money in the short run, consider going. If it's me, if I were young graduate, because I saw a question like, if you are in university today, what should you go for? If you have your emergency fund set aside and all else, I would suggest you go 100% equity.
And be prepared though that there can be some volatility, obviously. But yes, I agree. In the long run, that should be the one which gives you the highest return, right? And one thing which we frequently recommend is to, for example, DCA to, yes, you start with a lump sum, but then you also on a monthly basis top up, right? Because that means even if the markets go down after you start investing, you take advantage of the lower prices, and before the markets will hopefully go up again. Great. Thomas, it was really a pleasure having you join our webinar tonight.
Thanks for having me.
I think yes, was really insightful. Thanks, Melvin, for organizing or moderating tonight. I wish everyone a very good evening, and I hope to see you in one of our upcoming webinars. We are doing these webinars every week, every Thursday, and there's many interesting speakers and topics. Have a good evening and enjoy the rest of your week. Bye-bye.